Good evening. How are you? It is, what is it tonight? Gosh, I don't even remember. Isn't that sad? It's Monday. It's Monday. My gosh. Monday, March the 13th, 2023. I'm your host, John Schenk. Who's John Schenk? Well, he speaks about himself in the third person. And it's creepy, so I'm going to stop. I'm the founder and managing broker of Deerwood Realty in St. Louis, Missouri. We're a small residential real estate firm. Right now, it's just me. So, I mean, I don't know that you could get much bigger or much smaller. At night, I do the Deerwood Realty live stream. It goes on now, 9 o'clock. Normally Monday through Friday. The weekends get a little tough, but you know that. Mainly, I help buyers buy homes and sellers sell theirs in any market. In any market. I'm not just there for the good times. In fact, let's just start off with that. You know, I don't do well when the market's hot, okay? Everybody and their brother jumps into real estate when the market's hot. Like, I mean, it's insanity. If you look at the number of, I think there were more, at least for the last year or two, there were more real estate agents than there were listings. Like, that's how bad it gets. And you may say, well, I mean, that's great. Market competition forces wages down. I mean, 0 is not a good number. No transactions hurt. Okay. So I'm not in this for the hot times. It's not fun. In fact, I don't get many deals when it's really, really hot because everyone goes to their cousin or their brother who just got their license and they use them. And so I don't see any of the benefits of that at all. The only benefits I get are from people that I've worked with in the past over time that are like, hey, you know, we thought you did a good deal last time. Let's try it again. And so that's what we do. And normally we have success. I'm pretty happy with the way things go when I do my real estating. In fact, I was thinking today, and this I don't know how this is going to come across, but there are steps you need to take in being a real estate agent, okay? If you want to be a good real estate agent. And I don't like all the steps. I'm confessing this to you now. My favorite part of doing real estate is the actual transaction. The actual having a buyer and helping them find a house, or having a seller and helping them sell the house. That's what I like. It isn't out there, you know, looking for buyers and sellers, beating the bushes, calling people, pretending, you know, feigning some sort of interest in somebody's world. I'm just not that person. I'm not that person. You're not going to get me. I'm not a good associator. I don't associate with many groups. I'm a bit of a loner. And so that's just not the part of my job that I like. It's a part of my job. I don't disagree, but I would be best served just working with people that I like and helping them buy and sell homes. I don't know that I don't know that for my future, I'm going to sit there and, you know, randomly try to find people to buy and sell homes. I know that sounds weird, you know, coming from a real estate agent, that's all we do, but it's just not interesting to me. I'm interested in people, but I'm not interested in some sort of fake, you know, I don't know what it is. It's just irritating. It's some salesy garbage. I know a lot of agents are so uncomfortable with trying to sell that they say that they're consultants. I'm a real estate consultant, an advocate for your property, and I found that to be off-putting as well. I'm just a guy, and I like to help people buy homes and sell theirs. This other stuff is just, it's over the top. So anyway, I wanted to start the program. Look, what have we learned in the past, maybe 4 years? We've learned that you're only allowed to have an accepted narrative. Like there's this one narrative and everybody has to follow it, or else. It doesn't matter really politically what the narrative is, because that narrative shifts. It's not always one party. Okay? So, but there's all these, you know, this is the narrative and this is what we have to do. And so in times like this, I mean, if you've been around for the last 4 or 5 days, the only discussion has been, well, at least since Friday, at least, the only discussion has been Silicon Valley Bank. It's the only thing that anyone talks about, only thing that's of interest to anyone. Oh my God, what are we going to do with, but The problem is, like, Twitter is not real life. I talked to my wife tonight. I said, did you see the bank failure? She said, I don't even know what you're talking about. What bank failed? Nothing. Doesn't know a darn thing about this. Now, since Friday, people are just in a panic. I was seeing people on Twitter yesterday patting themselves on the back for having written so many tweets and responded to so many tweets during the day. And they signed off early because they had worked so hard responding to tweets about a bank collapse. I don't even remember the size of the bank anymore. It was a big bank, but I mean, what difference does it make? It's very interesting. So, as someone who wants to talk about current events, who wants to talk about, how things are set up, I mean, I'm like, it's like a moth to the flame. I'm interested in this all the time. But again, it's not real life. Okay. If I were to write a contract today on a house, okay, it would have nothing to do with Silicon Valley Bank. Nothing. Well, interest rates would be different, but we'll talk about that. But I think it's important, the narrative went from, oh my God, a bank's going to blow up, to, hey, the Fed's going to step in and fix everything. And people were calling for it. I mean, it wasn't just, and very, very smart people, don't get me wrong. The sharpest tools in the shed were all just, all for it. I don't have any idea what's going on. We're going to look at the news reports. I think this is one of those things where it's such a complicated explanation that we're never going to know what happened. You're going to get all kinds of varying opinions as to what's going on and what will happen in the future. And we'll go over some of those things, but we're never really going to know. During the 2009, 2008 crisis, the financial crisis, did you know what was going on? TARP and all that stuff? Just as an average person, did you pay attention? I don't know. I don't know what to make of it. So we'll talk about it. But and here's the thing: some people have suggested that this particular issue has become so important to talk about to deviate or to change the narrative from other issues. And since I'm on YouTube, I don't know what issues I'm allowed to talk about or not. I don't want to be shadow banned. I don't know what the narrative is on this. I see this as, I'll just tell you, for the whole Silicon Valley Bank thing, you have the quote unquote very smart people who are all in it together. Okay. And they mismanaged a bank. Okay. That's at the end of the day, they mismanaged the bank. And you say, well, John, how did they mismanage the bank? Well, here's how they mismanaged the bank. Other banks didn't go under this weekend. Okay. So it's not hard for me to figure out. Now for their trouble, okay, the guy made $10 million last year. Okay. The bank had. Apparently he had withdrawn or had sold stock this past week. Apparently bonuses had been given out to people that worked at the bank just recently. Okay. This was the slimiest of the slimy. All right. This is who people are. This is what we have. And no law, no amount of public flogging, nothing will change these people. And they are at the highest levels in government, the highest levels in the education field, any business field. They say the cream rises to the top. This isn't cream rising to the top. This is just disgusting human behavior. But it's not new. It's not new. Look, slimy people have been around forever. Okay? People are so complex. And I've always been fascinated kind of by this idea. Now, this man may have made $10 million, but he gave away $100,000 in charity. And then people can come at me and say, well, John, you didn't give away $100,000 in charity. So you're somewhat of a lesser because you didn't give this money away. Well, I didn't ever have the money. I didn't even have the chance. It's clear to me now. Look, I'm 45 years old. I was never going to make it. I have my MBA. Okay. I have an executive. I have a master's in real estate and construction management. I was never going to make it working with somebody else and dealing with that level of slime. I mean, these people, it was a very, I don't know if you ever watched Mad Men, but the main, I forgot his name. It was John Hamm, though, that character. Somebody said, how do you sleep at night? They go, how do you sleep at night? And he says, on a pillow filled with money. That's what we're dealing with. I mean, and in some ways, it's like, what do you want? This system we have, I'm not upset about we're not doing capitalism versus socialism, right? Look, this system values money on top of everything. How much is your integrity worth? Okay. That's all you need to know. Okay. For some people, it's quite a bit of money. For some people, it's not that much. And just know, like, I don't even know that I want people in prison for this. Okay. I really don't. But these people are all going to fall up. Okay. Every one of them. And that's the part that makes it even more galling. You know, there's these regular people that go about their jobs every day and they try to do good. The plumber, the real plumber, not, the plumbers. Guy goes out, works his butt off, comes home, he's tired, wakes up and does it again the next day. I mean, just works. The painter paints. You think that's easy on your arm to paint like that all day long? Oh my God. These people work, okay? They never do any of this screwy stuff, okay? But yet they're the ones that pay for it. They're the ones that pay for it. And it blows my mind. It blows my mind. They don't fall up, okay? If they go to a job, let's just say the plumber, puts a pipe down and it's the wrong kind of pipe and it collapses. He gets sued out of his business, okay? He gets no one will use him as a plumber and he will be ostracized and will have to leave the industry. This guy at the bank, he'll have a new job within 6 months. 6 months or a year. He'll pay more than what he made before. I mean, that's the world we live in. And I mean, you either accept it or you don't. And if you don't accept it, I don't understand. I don't understand. So anyway, I think my role is to revel at the just absolute horribleness of these people. Like when this happens. And then you watch like this army of like little insects crawling around protecting these people. It's disgusting. It's disgusting. It's not a political thing. It's just a human nature thing. It's disgusting. It's been evident all of my life. I saw it. I'll tell you, I don't want to hurt anybody, but I mean, in my own education, I watched superintendents come in to the schools that I went to, be there for like 2 years, 3 years, making six figures. Nobody knows what the hell they're doing. Leave and go somewhere else and use it as a springboard to make even more money. Like they weren't doing anything. I mean, it's bizarre. That's just one case. Some of the people I went to school with became doctors and lawyers. Those people were idiots. Like you do not want to be treated by those guys. Believe me. I mean, if you're in jail and you need a defense attorney, you don't want to hire these people. They're terrible. Absolutely. But they will fall up. They will fall up because they are part of the professional class. The professional class falls up. The average working man always, or woman, always gets beat down. I don't know. I just wanted you to know my stance so that there's no confusion. Now, if you're a millionaire and you want me to help you buy a house, I'll help you buy a house. I don't know how you got your money. I can't assume that you're a terrible person. Okay. But I'm also going to help the person that just is trying to make it. And then that leads to another thing. John, what if you help somebody buy a house and down the road they lose their house because they can't afford it? Like, it's your fault. No, it's not. No. I do everything I can to help my buyers get houses. There's people that I know that I want to help so bad. They've made horrible decisions in their lives, and there's no way I can help them buy a house because I can't find a mortgage for them. Okay. And it's terrible. It really, really hurts, but it's the way it is. They clearly don't understand the little box that you have to be in to get a mortgage. So anyway, I don't know. Was it a rant? I don't know. I just want you to understand where I'm coming from, so there's no confusion as far as how I see what is happening. I mean, and it's not just in banking. Okay, it's not just in banking. And I don't think it's going to change. There's no incentive for it to change. None. All right. So I got the new computer, and I'm changing subjects now. The level of productivity with my new computer has never been higher. I've been able to do things in the past week that, it's just fantastic. Why did I wait so long? I'll tell you why I waited so long. I run a business. I self-finance the business. I have no investors. Okay. All the profits I make, that's my cash. Now, I can either spend that on, luxuries like new cars or used cars, or I can spend it on my business. Or I can just hold the money. That's something that no one does anymore that maybe we should think about. No one holds their money for the rainy day because they know they're going to get bought. They're going to get bailed out. So there's no incentive. Plus, you can watch this argument, and I'm not immune to it. Okay, I'm holding cash. Okay, and inflation is running at way more than 6%. Okay. I'm losing money by holding it. Okay. And so is everybody else. I mean, except people that are making more than that, but I get that. But at the end of the day, if I can feed my family, if I can, continue in this business and not have to deal with the absolute disgusting people that are the executives of these massive organizations, it's fine. But anyway, on the computer, I waited until my other computer wouldn't even function. Like, it was so broken. The only thing I got back from the computer repair guy was the hard drive. Like, it was that broken. It was that out of whack. I could not edit things. I could not do anything. The computer was just dead, and I waited all this time. And all I can say is I'm sorry. I could have brought you probably a better product earlier. I could have brought you a better stream. I could have had better shorts. I could have done a lot of things. But I just was trying to conserve cash. Here's where it goes to me. Okay. I am an opportunist. I saw it's the same thing with the used car. Okay. I'm not buying one. I'm not buying one until it gets to some sort of normal level. Now, we'll talk about it. It doesn't look real good. I might be walking before I get another car. But we saw the crypto, the crypto farms. We saw the pandemic and people staying home. We saw the arbitrage of people buying, the scalping, people buying graphics cards and then turning around and selling them for a huge amount. And I said, when things got to a level where I can afford it, I will make that decision. Now, it didn't really work. I fought it as long as I could. Okay. But I would have waited longer. To get there. But this was a decision I made. All I can say is things are better. And thank you for those of you who watch like the day after, And for those of you who come to the channel and say, like, hey, maybe we'll give this guy a chance, I appreciate it. I want to say I got a new subscriber, and I only have 144 subscribers now. It's not like I've got a huge following, but I just wanted to say thank you to that person that subscribed. I had I always do this. I always get close to a number, and then I lose 2 or 3 subscribers. I don't know why. In fact, in the statistics in the back end, YouTube has this other for when I lose subscribers. So I don't know if that was a fake account or something. But anyway, I just appreciate it. So thank you to that subscriber. The goal is to get to 1,000 to get monetized. But even to get monetized, I have to have watch hours, and I need more watch hours too. So it's not easy. But I just want a home on the internet. I want a space where you can go and just hear from a relatively normal person going through life just like yourself, and see how that goes. I had something that popped into my head, but now it's gone. Sorry about that. We have a pretty solid show tonight. We'll talk mostly about the Silicon Valley Bank disaster. And we'll just go through it. And I don't know that I'll be bringing anything new to the table, but hopefully just a combination of things that I see. Maybe you can come along and ride along with me, and we can figure things out. So I think the first thing, how does what happened at Silicon Valley Bank affect me or my industry, real estate? Well, the first thing I wanted to show you was this. This is the Deerwood Realty website, but more importantly, it has the 30-year fixed rate mortgage survey pretty much every day except for the weekends. Mortgages dropped in the last 2 days. We were above 7, and now we are at 6.57% on a 30-year fix. That's down 19 basis points from yesterday. And then we lost a bunch of points on Friday during the bank, when people started noticing the bank issue. Now, I have told you, and I'm not lying, I'm okay with rates at 5.5%. I've always thought there needs to be some sort of value associated with financing, right? I don't understand. 0% financing to me seems wrong. And so I was never comfortable with lower rates, because all it does is, to me, inflate the prices of goods. I mean, when you have very, very cheap money, this allows you to have companies like Open Door, which is a flawed iBuyer model. It's absolutely joke. Carvana is an absolutely flawed business model for buying cars. And it's you have all these things, and they still go under. It's so bad that they still go under it, but you have this cheap money. But then you also have it in asset prices, inflation. So you get houses, you get the ability to borrow more, credit, larger lines of credit, anything that's financed, automobiles, everything just gets out of whack. And that's what we've managed to do. We need interest rates. We need them. I don't know why we play with them so bad. But we'll kind of talk about some of that stuff anyway. So we're down, okay? And so let's go to an article about what is the reason, okay? What is the reason that mortgage rates went down? It says mortgage rates down big, but lagging other indicators. And this is from Mortgage News Daily. It's from where I pick up my plugin for my site that does the 30-year fix. They're on top of it. So, I mean, I invite you to follow them. It says, if you're just getting caught up with or otherwise haven't heard, the biggest news in the financial market since last Friday has been the precipitous failure of the Silicon Valley Bank. While not necessarily a household name, It was the 16th largest bank in terms of assets and the second biggest bank failure in history, behind Washington Mutual 15 years ago. Combine that with the fact that the third largest bank failure in history, Signature Bank, occurred just 2 days later, and it's no surprise there's some panic in financial markets about systemic risk, also known as a domino effect, resulting in an additional turmoil. So now all we were seeing on Friday were these people that were invested in the bank or had some sort of, you must bail us out. And it got really weird, but let's continue with the article. It says, panic in the financial market is usually good for interest rates, with U.S. Treasuries almost always doing much better than mortgage rates. This episode has been no exception. The U.S. Treasury coupon that markets often use as a benchmark for mortgage rates had fallen almost twice as much as mortgage rates on Friday, but the gap is starting to get a bit tighter. Each of the past 2 days, we saw the average lender move lower by roughly 0.2%. But it should be noted that there is a wide disparity between lenders and loan programs. Moreover, timing varies. Some lenders improved more on Friday and less today. All we can do is comment on the averages, and in that sense, this is the second biggest two-day drop in rates since March of 2020. Okay. Speaking of big things, the bigger question is what's next? What indeed? There are more questions than answers right now. Some say the bank failures are evidence that the Fed's tough interest rate policies have broken something and that they must now dial back their intensity. Others say the Fed knew some things would break and that they're only going to dial back if lower inflation says they can. To that, others say that inflation is even more likely to move down now that people are worried about the banking system and a recession. And to that, I say we just don't know yet. All we do know is that these bank failures are very different than those seen before the financial crisis in several important ways. We also knew the Fed, FDIC, and Treasury stepped in with non-taxpayer funded plan to calm the market, and seems to generally be working today. We'll go over more about that. We've got some discussion about that. If the market is calmer, then why are rates still so much lower? This has to do with the market shifting its expectations for the Fed rate hikes in the rest of 2023. Specifically, the market now sees the Fed hitting a ceiling rate that's more than 1.5% lower than it was at the beginning of last week. Look, be careful what you wish for. Seriously. You think inflation's not going to go unchecked? It's just a horrible, horrible situation. If that continues to be the case in the coming days, mortgage rates could move down even more. We'll learn more about those odds at two key moments tomorrow morning at 8:30, where we get the next major inflation report, and then on Wednesday, when the Fed releases its latest policy announcement. So this week is going to be packed with stuff. Packed with stuff. Now, this weekend, people on Twitter's not real life, people on Twitter were saying it's a moral hazard to bail out the banks, quote unquote, bail out the banks. Now, I've tried to explain this. I've tried to talk about this before. Okay, look, communication is hard. And people intentionally make it more difficult when they're looking to game the system or game their opponent. Okay. Some people will say today that the bank was not bailed out, that Silicon Valley Bank was not bailed out because it ceases to exist. Who was bailed out? The depositors were bailed out. Why were the depositors bailed out? Well, to me, the depositors were bailed out because since I was a kid, FDI Insurance said that they will insure $150,000 in bank deposits, okay, on any one account. And then apparently during the financial crisis, it had been moved to $250,000. But as a kid, I understood this very simply. So that means if I have more than this amount in the bank, it's not insured? Answer, yes. That's absolutely right. Now, how did all these financial geniuses figure this out? I have no idea, but their money was not secured, okay? It was not insured. And so anything over $250,000 to me is a bailout of that bank. Now, you can disagree with me. You can say because the shareholders aren't going to be bailed out, or the equity holders aren't going to be bailed out, Therefore, you're wrong. And that's fine. Let's just be honest though. We have two different. We have a very different opinion on what happened. I don't know the truth. But the communication is the part that's the problem. So what I want to get to next is when you have this stuff happen, this whole episode, in short, has been things that I've seen through my life. This is like, it's like my calling. We can just watch it from a distance and just, maybe I can show you what I've seen. So we don't agree with what happened. Okay. By definition of what a bailout is. We don't agree. All right. So I just so you know. So then the next thing on Twitter that we saw is to bail out the bank is inducing a moral hazard. Okay. And I was like, I've heard that before, but I don't remember it. Why? So now it becomes, okay, what is the definition of a moral hazard? And so I'm going to read a definition of the moral hazard because I don't know if this is the way they're using it. And understand words have now been twisted in our language to the point where you're never sure, like affordable housing has got nothing to do with affordable housing, like what you think it does. That's just one example. Okay, so here we go. This is from CBS from 2013, okay? 10 years ago. What is a moral hazard? The term moral hazard is heard frequently in discussions about how to reform the healthcare system and the financial system. So understand, things have not changed in a decade. We still have issues in our economy. For example, in a recent speech about regulating the financial system, Federal Reserve Chairman Ben Bernanke said, as we try to make the financial system safer, we must inevitably confront the problem of moral hazard. And a recent Boston Globe editorial on Obamacare said, there is the risk of moral hazard. People might sign up only when they are sick, and that would make the system too expensive to sustain. Now, have they made the financial system in the United States safer since 2013? What is a moral hazard? Moral hazard is so there's other words like self-fulfilling prophecy. That's one. Another one would be, perverse incentives. There's another one, but I don't remember it off the top of my head. But it's based on when you make a decision and you really don't know the unintended consequences. I'm sorry. What is moral hazard? Moral hazard is a term describing how behavior changes when people are insured against losses. Okay, then that's the definition we'll use. Based on this, if someone else brought me another article and had a different definition, we'd use that one. Okay, I'm just going to go with what I read. I don't care who wrote it either. It could be left wing, right wing. I don't care. I'm just saying this is what I'm reading. This is the way I'm going with it. If, for example, your car is fully insured against any and all damage, there's no deductible, then you'd have no incentive to avoid minor accidents like scratches or backing into poles beyond the inconvenience of getting the car fixed. You would be much more likely to take risks that could lead to minor car damage, knowing that your damage is fully covered, any damage. Now, look, this is what I thought was the case with Jackass, the television show. When you saw those guys jumping around like idiots, okay, and getting hurt, like they were getting hurt because they had insurance. It wasn't going to cost them anything if they got injured. Now, you say there's a physical element to it. Yes, I agree. However, there was never any sense that anything, so what if they were hurt? It's funny. We can all go around, jumping off of houses and whatnot, and it's fine. It's fine, right? That's moral hazard by definition. How does this apply to the financial sector? If the government is forced to bail out too big to fail banks, this was in 2013 and it's now 2023. Now look, I just looked up Google. I didn't try to cherry pick the article. Bail out too big to fail banks to avoid catastrophic consequences for the entire economy, then bankers effectively have government insurance against losses. Well, wait a minute. That gives them the incentive to take more risks when they invest the money that is deposited with them, and that increases the chance of a financial crisis and that a bailout will be necessary. Well, gosh darn it, guess what happened? Guess what happened this week? In healthcare, just as people are less likely to take good care of a car when they have full insurance, and just as they would rather get the car fixed more often, or just as they would fix the car more often, people who have health insurance are less likely to avoid risks. As a result, they go to the doctor and use other medical services more frequently. That has the potential to increase healthcare costs. Wait a minute. So if I've got something wrong with me and I go to the doctor, that's a bad thing? What the hell's wrong with? I mean, things have gotten off the rails. What's the solution to a moral hazard? Well, that's good. Let's find out. It says the most popular solution to the moral hazard problem is to make people pay a share of the cost of the hazardous or risky behavior. Who's paying the cost of the risky behavior in the bank bailout for Silicon Valley Bank? In auto insurance markets, this comes in the form of a deductible that forces the car owner to pay for minor damages in full and to pay a relatively large share of a more costly damage. Since the car owner must pay for some or all of the damages, he or she is more likely to be a careful driver, less likely to park so close to other cars that get door nicks, and less likely to take the car in for repairs and so on. Well, I mean, maybe they should, though. I mean, if their brakes are kind of malfunctioning, maybe they should. It's kind of funny. It says, in the auto insurance markets, this comes in form of a deductible. It forces the car owner to pay for minor damages in full and pay a relatively large share of a more costly damage. Well, then why have insurance? Is insurance a scam? I mean, like the biggest one ever? And health insurance markets have similar mechanisms to offset the incentive to take on too much health risk and use medical services excessively. Copays for office visits and deductibles on charges for healthcare services in financial markets. I don't know about that. In financial markets, the mechanism for avoiding moral hazard is a bit different, but the principle is the same. The key is to make sure that those who are making the decisions about how to invest other people's money face consequences if they made bad investments. So you tell me who is facing consequences for what happened? The employees of the bank who got fired? Like the poor teller at the window? I mean, that's kind of unfair, isn't it? Like, what did they do wrong? If the government simply bails out too big to fail firms and makes them whole again whenever they take too much risk, the individuals won't face large consequences for their actions, and they'll have no incentive to attenuate their risky behavior. Well, what just happened? The Dodd-Frank financial, by the way, remember the name Frank. Dodd-Frank financial reform law enacted in 2010 attempted to solve this problem by giving regulators what is known as resolution authority. Under this authority, large, systematically important banks must have plans drawn up in advance for an orderly resolution should they get in trouble. Plus, how big do they have to be? Thus, unlike in the past, these banks will not be saved if they are in danger of failing. Instead, the orderly resolution plans will be executed. The banks will be allowed to fail, and the bank managers who made the decisions that led to the trouble will be out of a job. For how long, though? For how long? And you know, the head of the bank is going to say, it wasn't me. It was the other guy. It was the person in charge of risk. It's their fault. There is some question about whether the government will have the will to exercise this power when the giant bank is in trouble. Well, we found out, didn't we? What if the orderly resolution plans don't work after all? But banks executives certainly face larger personal risk today from taking on excessively risky investments than they did in the past. Bull honky. Bull honky. They are fine. They fall right up. Whenever people are protected from the downside of their choices, they tend to take on additional risk, sometimes excessively so. If taking on additional risk has the potential to impose costs on other people or puts other people at risk in some way, such as a financial system breakdown, then some mechanism is needed to temper the risk-taking and protect innocent bystanders from the consequences of morally hazard behavior. Written in 2013, now 2028, moral hazard. Nothing has changed since 2013. I really messed up. I was supposed to put things in a certain order and I didn't. Oh, goodness. All right. Well, so that ends the portion of our program devoted to like learning what a moral hazard is and what rates are doing, which is what's important to my business. Let's go, and don't look at the next article because we're going to flip over to Twitter. Markets and mayhem with a meme, maybe. Markets with signature banks collapse. U.S. reformer Barney Frank watches his own lender fail. You got that right. The guy that authored the Dodd-Frank financial bill that was going to rescue and strengthen the financial markets in the United States and therefore the world was on the board of Signature Bank as it has collapsed this weekend. I kid you not. And this is how you know the world is broken. Santiago Capital. For all those caught in they should do this or shouldn't do that arguments, all I can say is that the sooner you remove the word should and shouldn't from your investment vocabulary and start focusing on will or won't be done, the better off your portfolio will be. Very, very, very smart. And we were talking about this last week. I said, look, if the financial, if the financial markets melt down, the Fed's going to step in and bail them out. And you say, well, why? Why? What makes you think that? It's like they're not going to let anybody fail anymore. There's no moral hazard situation anymore. Everyone forever is just given a free pass as long as you're politically connected. And they will do it until it finally can't be done anymore. Okay? This is in some ways all of this is a fantasy. Okay, what we see in front of us is our interpretation of the world in which we live in, okay? Someone else has a very, very different view of what's going on in the world. This is true with the financial system. They will just make things up. I watched it during the last crisis. The bondholders normally get their money first in the Chrysler deal. That didn't happen. They were not made whole. They will change the laws. They will change everything. You must not focus on what they should or should not do. Focus on what they will or won't do. And in this case, they will bail out the banks. They will always bail out the banks. When the automotive industry was on its last legs, they bailed them out. Any big industry will get bailed out. You say, well, it's not a bailout. Come on. They're not allowed to fail. And you say, well, what about Bear Stearns? They failed. But how did that work? How did that work out in the end? Just saying. Jeff Winiger, raw materials prices down 36% in the last year. What happens to raw materials now shows up in CPI later. Feel like central banks messed up so badly that they're overcompensating. I'm respecting this chart. Somebody wrote it, services they rightly have their eyes on. So raw materials down 36% in the last year. What happens to raw materials now shows up in CPI later. Feel like central banks messed up so badly that they're overcompensating. I'm respecting this chart. Well, you do understand that Friday, they thought they were going to raise rates. And now no one expects to raise rates. They may see a rate cut. Insanity. The Clash 2022, Jesus Christ, you hit it out of the ballpark on this one. When interest rates are zero, people do stupid things. My paraphrase, it should cost you money to borrow. It should cost you money to borrow. There should be risks in lending. There's nothing wrong with rates at 5%. That means are prudent with your money. Look, this is exactly right. It should cost money to borrow. Sid Prebu. What's the biggest grift in America? Banks, health insurance, or the military-industrial complex? You know, I always thought it was the military-industrial complex. But banks, in my lifetime now, they've just totally. By the way, I don't even bank with. Now look, you can make fun of me. I get that. Okay, it's okay. When I saw the banks mismanage the 2008 disaster, I said, I'm not doing this. I'm not going to be a part of this. I'm going to a credit union. You may say, you're an idiot. Do you realize how dangerous a credit union is? I don't know. Look, all I'm saying is I don't want to be a part of this bank thing. I just don't. I'll just take my chances on a credit union. I need a place where I can deposit my money, and it's never more than $250,000. So I don't have to worry about that. I just need a safe place to put it. Credit union. You should look at credit unions. Not sponsored. Although, if you were a good credit union, had a history of not, being terrible, hit me up. I'd sponsor you. Oh no, you should sponsor me. I've got it so backwards. Then it says, thanks Obama, healthcare story in 4 parts. I don't know. It says, let's see if we can do, this is the beginning. It says, I don't think it's in ideological terms. I never have. Obama said, continuing on the healthcare theme, everybody who supports single-payer healthcare says, look at all this money we would be saving from insurance and paperwork. That represents 1 million, 2 million, 3 million jobs of people who are working at Blue Cross Blue Shield or Kaiser or other places. What are we doing with them? Where are we employing them? So he's saying, like, look, if we only have single-payer insurance, all these people lose their jobs. That's not a good plan. Then it says federal subsidies. In the CBO and JCT's projections, net federal subsidies, that is the cost of all the subsidies minus the relevant taxes and penalties in 2022 for insured people under the age of 65 are $997 billion, or 4% of the gross domestic product. In 2032, that annual amount is projected to reach $1.6 trillion, or 4.3% of the GDP. Over the 2022-2032 period, subsidies are projected to total $13.4 trillion. Okay, and then you see here, the average family health insurance premium in the U.S. has more than tripled since the Affordable Care Act was signed into law back in 2010. The biggest beneficiaries health insurers, United Health Group, the largest U.S. insurer, is up 1,864% versus a 350% gain for the S&P. And here's what the top 5 payer CEOs made last year. Centene, St. Louis-based company, $24 million, almost $25 million. CVS, I think they were here for a while. I don't know. $23 million. Sigma, $20 million. Anthem, $17 million. Humana, $16 million. I mean, they're doing okay. I don't particularly like to kick Obama at all because it's all like political. It's like if I say something against Joe Biden or Trump or Bush or anybody, it's like somebody's always going to have some issue. So I don't particularly want to go that route. But then he writes, this is amazing. The Federal Reserve pays banks 4.6% on reserves, backstops their rates and credit risk, and allows them to pay 0% to their depositors. This is the biggest scam I've ever seen. You would have to be an idiot not to start a bank now. Well, I mean, that's just it. It seems like it's easy money. He writes again, and the banks, there's no reason for them to exist. The default-free assets could migrate to the Federal Reserve, while the money-like claims would be better managed by money market funds. Other fixed income assets could be absorbed by bond funds and ETFs at new prices, but that's life. While investor appetite for private credit suggests that even parts of the bank's core lending franchises could be segregated from insured deposits without too much disruption. Look, I'm of the opinion, I mean, some will argue that Silicon Valley Bank is in default because of regulation stipulating that they had to have so much in quote unquote safe investments that just happen to be mortgage-backed securities that just happen to have a massive and dramatic change in pricing in a short period of time, that set off alarm bells to people that are pretty smart people and really smart. And they said, we're getting our money out of this bank because this is not good. And then they were done. I think that's a fair argument. Like, I think that's fair. If you're going to have the Fed, like, so let's go with that. Okay. Then it's the Fed's fault that this bank ate it. And so who fixes the problem? The Fed. Well, isn't that convenient? And so at this point, if the Fed causes the problem and the Fed solves the problem, then why don't we just bank with the Fed in the first place? Why even bother with this illusion that banks have any control over what they do? And you say, well, John, that's not really actually true. That's quite an extrapolation. I don't really think, I don't see it that way. That's fine. Then let's talk about, like, what are banks supposed to do? Why have they gotten into so much trouble recently? And I say recently, let's say historically within the last 25 years. Like, who's playing these games and why is this an issue? And how would we not be better served by the government being our bank? Isn't the government kind of our bank anyway? I mean, they're screwing with the value of the dollar so bad. I mean, it's just bizarre to me. It's just bizarre to me. Maybe you think differently. Jim Bianco, BiancoResearch.eth. Today, the 2-year note yield declined 61 basis points. This was the biggest one-day decline since October 1st, 1982, the first discount rate cut following the September 1981 all-time peak in yields. To emphasize, today's decline in the 2-year was larger than any one day seen during the 2007 to 2009 financial crisis, following 9/11 and the 1987 stock market crash. If markets signal, what's the 2-year telling us? It just seems bad. It doesn't seem good. We're not going to focus on what should or shouldn't happen. We're focused on what will happen, and they will paper it over. These people are going to paper this over until they can't paper it over anymore. That's all it is to it. It almost doesn't matter. This woman here, value stock strategist at Zacks, manager of the value of investor and insider trader portfolios, podcast house, writing about housing on Substack, Chicago. Let's just go over it. She writes, FYI, she's retweeting. So who is paying for the bailout of Silicon Valley Bank and Signature Bank? Answer, fees on banks. A special fund was set up after the 2008 financial crisis. It currently has $100 billion, so no taxpayer money. Okay. You have to really be, let's just, do you really think, like, let's go into a different industry. When someone wants to build a hotel in a downtown area that shows no statistical need for a hotel, they go with we're going to build this and it's not going to cost the residents anything. You're going to finance it. It's not going to cost the residents anything. No, it's going to cost all the people that go and live or go and get a hotel room. It's going to cost them a fortune. And to me, that is like, we're going to build a stadium in downtown St. Louis for the Rams. Okay. It's not going to cost taxpayers anything. Okay, great. Well, what's going to be fun about it? A hotel tax. Oh, so we're going to kind of dissuade people to want to live, or we're going to dissuade people from visiting the city. Well, no, they just won't know. Well, wait a minute. Like on a nightly bill, it's like $25 in taxes and fees and surcharges. What is that? Oh, well, that's fine. People like our residents aren't paying it, so it's okay. Somebody is paying it though. That's the issue I have with this. Look, you want to say look? No taxpayer money. Okay. My understanding is that the Fed was working all weekend long. Who paid for that? Was it taxpayers? All these regulators they're bringing in, and they're going to have a new CEO of the bank and all this other garbage. Free? Free? Special fund set up that currently has $100 billion. No taxpayer money. Fees on banks. Do you think that any bank in their right mind, now that they know that the Fed is going to back them up no matter what their deposits are, do you really think they're going to not pass any fees they incur onto the people that put their money there and that use the bank? So no fees on taxpayers, just fees on everyone else that uses a bank in the United States. I mean, come on. What is wrong with you? How can you possibly say, on one hand, no taxpayer money with a straight face, knowing full well that everyone that has a bank account in the United States is now going to pay more in fees because of these banks going under? Dishonest, disingenuous analysis of a crisis. And to FYI this, just the broke agent, you can tell the agents who have been through it because they show zero emotion when something horrendous happens. I'll tell you what, there's a lot of truth to that. Like, you heard about beating a dead horse. Let me tell you about my situation a while back. I had a woman die. I had a woman die, my client, before we listed the house. Like, that hurt. Like, I mean, like, really bad. Like, not because I lost money, because I ended up listing the house. No. The physical and mental toll of your client dying and you having to call, someone, and seeing her on the ambulance, in the ambulance taking her away from her home. Okay? That's traumatic. Let me just put it out there. Very traumatic. I had a deal this past, maybe a month or two ago. Ready to close. Everything's done. Ready to schedule the walkthrough. I'm the listing agent. I say, hey, ready to see you guys do the walkthrough. The agent says, you know what? We're not gonna be able to close. Mortgage company won't allow it. Here's your money back. We're done. Didn't even faze me. I mean, truly, something happens, you have to fix it. Or, I mean, it's going to get fixed. No matter what you do, it's going to get fixed. Some way. A lot of truth to that one. Oh, that's my followers. I hope you didn't see that fast enough. Let's go over here. I thought this was interesting. I want to bring you, audience, I want to bring you what I see as an agent and then what people feed to us as agents. Now, I have the benefit of not having to go to a brokerage where we have like Tuesday morning meetings at 8 o'clock that are non-required, but everybody seems to show up to them, and have a bunch of BS just spewed at me every week about, how the market's great or how you should use this product that's sponsored by us because the guy took me to dinner and all this other crap. I don't have to deal with that. And it's a blessing. But you get stuff like this, and I kind of want to go through it. I'm not saying this is bad. I just want to see, I want you to understand what people think of you, the real estate client, from the perspective of the real estate agent. As a real estate agent, you want to be a trusted resource for your clients. You want to have the insights and experience that they need to help them navigate changes in the market and better understand the ups and downs that naturally arise in the real estate sector. Real estate agents understand that a market cannot perform well perpetually. A natural rise and fall in prices always occurs. When you start to see signs of a market correction, you want to know how to connect with your clients and prepare them so they can make the best real estate decisions for their individual goals. This insight will help you continue to provide clients with outstanding service they can trust. Well, are we seeing signs of a correction? Is that your argument? What are the signs to which you're referring? Is this just a random article? Or is this today? I don't know. I don't know to start. What is a real estate market correction? Now, here, I appreciate this. We're going to define what a correction is according to this person. Real estate market correction can generally be referenced when the value of a home falls 10 to 15% below the market average. When the value of homes starts shifting like this, it can cause changes in how buyers and sellers look at the market and how they plan their real estate transactions. Within the luxury housing market, noting these changes has particular significance. Changes that indicate a market correction are often felt particularly strongly in the luxury housing market. Typically, this sector sees the first signs of value reduction, and home values see the most dramatic changes in price. Therefore, buyers and sellers will want to make sure they fully understand these conditions as they evaluate the market. Now, I appreciate the understanding of what a correction is. However, they fully understand these conditions as they evaluate the market. Like, you go to your client and you say, they say, hey, I want to list my house. And you say, okay, well, it's going to be 20% less than what you paid for it. And they say, what? I mean, there's no real evaluating there. That's just like, this is what's going to happen. The luxury market, how to prepare for changes. Before you speak with clients about an impending market correction, you'll want to make sure you have adequately prepared yourself for the conversation. Luxury home clients will likely want to access detailed information about the current economic conditions and how it compares to similar past experiences. Here are some key pieces of information you want to have available. I reject the notion I could give somebody an encyclopedia of data and it really wouldn't matter at the end of the day. It's what sold yesterday, what will sell tomorrow, and for how much. That's it. That's it. I used to work for a guy that was a buyer's agent. He had a notebook this thick. School districts, per capita this, all that crap. You know, if anybody ever went through that book, they'd be so sick of them. So they just want to go and they would never want to use you as a buyer's agent because you just made them ill with data. Anyway, now I don't have any luxury clients, but I mean, what do we talk? We didn't define luxury in this case. We defined a correction. We're going to go over 1 million. Like, that's people that had a house that was 600,000 like 4 years ago. Okay, so we want to have this data, current market housing data that explains performance. Many clients will have already seen signs that prices have begun to drop, but they want to know how it will impact them and by how much. Well, good luck giving them the exact number since we're in the middle of something. You want to come to the conversation prepared with relevant market data specific to their property, offer them insights such as how long similar homes have sat on the market in recent days, the call rates for different properties in similar markets, and any substantial price adjustments that other homes in the area have utilized. Providing your clients with this data can help them see how their property fits into a broader market pattern. Look, they care about themselves, and there's nothing wrong with that. They don't really, like, somebody's house down the street to them, they don't really care. It's not their house. They care about their house, and their house is the best house. That's all you need to know. Interest rates and stock market data. Clients will also want to see data information and shifting market conditions and how the real estate market influences and is influenced by factors such as interest rates and the stock market. Just like any other buyer, luxury clients know that interest rates will impact the value of the house they can buy, and following interest rate data can help them evaluate the current trends. Look, they made their millions in something other than real estate, and the idea that they can't figure this out on their own. Luxury buyers will also have sizable portfolios of investments in the stock market, and many will look at their investments when evaluating their liquidity and assets they have there available. Therefore, buyers want to know how the stock market trends align with the real estate market. So we're going to... Mr. Wealthy Homeowner, your stock portfolio declined 25% in the past year. Houses are going to decline 14%. There. Past real estate market corrections. Finally, you want to prepare so that you can come to the conversation equipped with information about how your area and the luxury real estate market in your region fared during the past market corrections. Data about how low prices dropped and signs of the turnaround can help clients evaluate their current position in the correction, how they can benchmark the current situation. For example, you might want to use data points from the 2008 Great Recession and let clients know how their market is currently performed compared to their time period. These benchmarks can help buyers and sellers feel more confident in their decisions. Well, I mean, it was a shot, okay? It was a shot. They tried. That's a hard article to write. I'm not going to kick them for it. I thought this was interesting. I thought this would be more interesting to talk to my clients about if they were interested. But again, I've never really gotten to a point where we just sit at the kitchen table and talk about market forces across regions and how things happened in 2008 and why they're different now. I don't know, call me sheltered. Households' real estate asset value falls for the first time since 2012. Well, that doesn't sound good. What does that mean? It says in the most recent release of the Z1 financial accounts in the United States shows a decrease in the value of households' real estate assets over the fourth quarter of 2022 as home prices begin to decrease from pandemic highs. Households' real estate asset value fell for the first time since the first quarter of 2012. The level of households' real estate assets decreased by 0.07 trillion from 43.57 trillion in the third quarter of 2022 to 43.50 trillion in the fourth quarter of 2022. The market value of owner-occupied real estate increased 10.77% on a year-over-year basis from 39.27 trillion in the fourth quarter of 2021. So this is a pretty heavy article. All right? Let's be fair. Let's continue the article and let's try to make sense of it. Real estate secured liabilities of household balance sheets, for example, mortgages, home equity loans, and HELOCs, home equity lines of credit, increased over the fourth quarter from 12.36 trillion to 12.52 trillion, a 1.25% quarterly increase. Year over year, real estate liabilities increased 6.48% from 11.75 trillion in the fourth quarter of 2021. The year-over-year growth of real estate liabilities has decelerated for 2 consecutive quarters as home sales have slowed across the country. Aggregate owner's equity, the difference between homeowners' real estate assets and liabilities, fell from 31.21 trillion to 30.98 trillion, representing 71.22% of all owner-occupied household real estate. So the difference between assets and liabilities and equity give you that number. I don't know. A little too heavy for me tonight. Feel free to explain it in the comment section for those, do it like a 5-year-old. Explain it to a 5-year-old. I mean, to me, that would be like money down. Bad. You do it your way. Last article of the night. I almost didn't think we'd get there. I mean, the show's gone so fast for me, and I'm in it. I hope you're having a good time. If you're watching tomorrow or 6 months from now, hey, would you subscribe? I'd appreciate that. Also, wanted to put out there, I've asked you to subscribe on Rumble so that I can live stream, and 2 people did, and I just want to say thank you. I need to be at 25, I'm at 16. I know Rumble's not real easy to use, but it's getting better. It's getting better. All right. I thought this was a nice article. I thought we could go over it. It's on Fox Business, the real estate section. It says, first-time home buyers battling rapid decline in affordability. Numbers are just not working. The Atlanta Federal Reserve reports U.S. households have to spend nearly 43% of their monthly income to afford the median house price. Well, this is the problem. It's a lot easier to make everyone poor than everyone rich, which kind of explains the Fed and how that works. If you're stretching your bottom dollar and doing everything right to buy that first-time home and still striking out, you're not alone. According to the Federal Reserve Bank of Atlanta, U.S. housing affordability is its lowest level in a decade. As of December, the median American household would have to spend 42% 42.9% of their income to afford the median priced home. But that's the median to the median. The data shows that housing affordability is worse today than during the peak of the 2008 housing bubble. It is also well above the 32.6% share just 1 year ago. At this rate, the typical American is paying about $607 more per month to own a median priced home compared to last year. The numbers are just not working right now. Homeowner hopeful Sam Pascal said along with his wife Jackie on Varney & Co. Thursday, I think what we're seeing is that buyers are holding on to their homes, and there's little supply and they don't want to let go. I would say sellers are holding on to their homes. Sam and Jackie claim to have followed all the correct steps to a successful financial future. They paid off their student loans. Well, good for them. That is great. Saved money from their individual incomes and started building generational wealth. I don't know what that means. But after being in the housing market for more than a year, the couple is now delayed starting a family until finding their perfect home. Well, that's sad. That's sad. I'm hoping we'll find a home, Jackie added. However, we still do have to go through these emotions, this journey. Home buying is a journey no matter who and what the situation is. The rapid decline in affordability stems from the highest mortgage rates in years and steep home prices. That's right. Even if you, and we'll talk about this at the end. I'm not going to talk about it right now. During the COVID-19 pandemic, home prices soared at a pace not seen since the 70s, with mortgage rates near record low. Home buyers who were flush with stimulus cash and eager for more space during the pandemic flocked to the suburbs. Demand was so strong and inventory so low that at the height of the market, some buyers waived home inspections and appraisals were paid hundreds of thousands over asking price. Look, that's all going on right now. Like, they're waiving appraisals and they're waiving home inspections in St. Louis today. But the frenzy came to a halt when the Federal Reserve started its most aggressive rate hike campaign since the 80s to crush runaway inflation and in some ways crush new home buyers with it. I don't know what you're talking about. Like, this isn't even, it's still happening. The buying frenzy never stopped here in St. Louis. It's still ridiculous. An increase in the mortgage rates has put many home buyers back on the sidelines once again, especially first-time home buyers who are most sensitive to affordability challenges and the impact of higher rates. MBA's Vice President and Deputy Chief Economist Joel Kahn previously told Fox Business. It's a mouthful. Even with higher interest rates putting homeownership out of reach for millions of Americans, prices are still steeper than just 1 year ago. The median price of an existing home in January is $359,000, increasing 1.3% from the same time a year ago, according to a separate report from the National Association of Realtors. This marks 131 consecutive months of year-over-year home price increases, the longest-running streak on record. Prices, however, have moderated slightly after peaking at a high of $413,800 in June. Okay, that was the last article. Closing this out for tonight. Let's have a small discussion to end the show, and that is this. We talk about what should or shouldn't happen and what will or won't happen, as Santiago Capital put it. Look, when you lower interest rates, people can buy more house. Okay? That's not good, because when you know you can buy more house, you're willing to spend more money, which means the price of the homes will be inflated even more than they are now. And the Fed, if they are taking their foot off of the brakes and saying, okay, inflation, come on, is a truly disastrous situation for housing. It's just not here yet. I mean, people are getting soaked in the marketplace, and now you're going to get them, they're going to do it again. The people that are left holding the bag are not the bad people here. It's the people pushing these policies that are ridiculous. Ridiculous. You really don't understand. Like, people are praising people are honest to God praising lowered interest rates right now. Real estate agents across the country are running through their offices saying, my God, look at this. We're in the 6s again, and pretty soon we'll be in the 4s. Woo! Look, the prices never went down from earlier this year. They're just going to go up. Now you say, John, isn't that great? Prices are going to go up. No, it's not great. If you're a buyer and you could hardly afford something before, it's not going to get any better. It's going to get worse. Now you say, are you predicting a home price crash? Yes, someday in my lifetime. Yes. I'm 45 years old. By the time I'm dead, there will be a housing crash. There, I said it. Now when? That's up for debate. I have no idea. Next week, next month, next year, 5 years from now, I don't know. It's coming. This is going to come to an end. And when it does, some people are going to be very hurt by this and crushed by this. And the people that cause the problems are going to be on their yachts. They don't give a damn about you. So just keep that in mind. This is all an illusion. This is all a shell game being played by people that are not that bright. I'm just telling you. They think they are, but it's going to hit them at some point. Well, with that positive note, we'll be back tomorrow, 9 p.m. I had a great show tonight. I hope that if you're watching it and you say, John, man, that show was much better than when you started. Thank you. 1% a day. I'm a 1% a day. Try to get better just 1%, and that should lead to some great things. If you have any questions or comments, put it in the comment section. But yeah, 9 o'clock tomorrow. I'll try to put a placeholder early in the morning so we can get some more people in here. But thank you for watching. Thank you for listening, and I'll catch you on the next